Want to welcome everybody to the Economic Outlook for 2021. My name is Mark Murray. I'm the chairman of the Mount Vernon-lee Chamber of Commerce. Co-host for the Outlook today is Mark Viani, who is our president of the Southeast Fairfax Development Corporation. Chamber is partnering with the Southeast Fairfax Development Corporation to make this program available to local businesses. Mark, take it away.
Mark. Yeah, thanks, Mark. I appreciate it. We're pleased to, on behalf of SFDC, we are pleased to partner with Mount Vernon-lee Chamber on the 2021 Outlook. I also want to offer my compliments to Holly Doherty, the executive director, for all the hard work she put into making this happen under really kind of unusual circumstances. We welcome our distinguished guests and our speakers for the Economic Outlook panel, who will be introduced during the program. We extend warm welcome to both Supervisors Rodney Lusk and Supervisor Dan Stork and the members of their staff as well. Mark, back to you.
We'd like to recognize our sponsors that have contributed to the success of today's program. Presenting sponsor is Walsh, Colucci, Libley, and Walsh. That's Lynn Strobel, who's representing them today. Economic Development Champions are Covanta Fairfax, Don Camerata. Christopher Consultants, Mike Kitchen. Pannoni, Dave Stiegler. Economic Development Advocates are DeLune Corporation, Gaddafi Ismail. And Opfinity, Michael Drubness. I want to extend a personal thank you to each of the businesses that support this event. Mark?
As I noted before, we're honored to have our local supervisors with us this morning and invite each of them to give a brief welcome. I will introduce Supervisor Stork, and after his remark, Gaddafi Ismail with DeLune Corporation will introduce Supervisor Lusk. Dan Stork began his service as the Mount Vernon District Supervisor in 2016. He leads the Fairfax Green Initiatives and was instrumental in the MBARC Comprehensive Replan Amendment to redevelop Richmond Highway. He is a former school board member, a businessman that has developed and owned several healthcare companies and benefit firms, with a history buff who loves portraying Abraham Lincoln, as my kids who both went to Fairfax County Public Schools can attest. Does a very good job. Supervisor Stork, turn it over to you.
Well, thank you very much, Mark. And it is a pleasure to be here and a pleasure to be, frankly, at one that we can actually get together. I know last year we struggled with, like everyone else, with the pandemic, and it was an incredibly difficult year economically, especially for the corridor. We have lots of wonderful things that are happening, but one of our challenges is that we still are heavily dependent upon commercial activities, whether it's clothing stores or restaurants or hospitality. So those have been really the mark of the year, and one that we are looking to rapidly accelerate out of as people get the vaccine and get more comfortable with visiting our local tourism sites, as well as frankly just getting back to more than normal. So the county has been very involved, the RISE program, and we've talked about a number of others since then that have made a difference, we think, for our businesses. But we know nothing can make up for the mere fact that we need people to be returning to more of their normalness, if you will. And that means we've got to pay particular attention this year to the economic development information that we get from our technical experts. And I look forward to hearing from them this morning. We have a very, very vibrant, successful corridor which kind of got a haymaker to the job this past year, but one that we are still continuing on with really all the major projects that are really will make up our future, really the 21st century that we're building right now with the bus rapid transit line and the widening of the highway. The number of economic development initiatives with the Chamber and SFDC have really had key roles to play in this. So with all that, we are deeply thankful for having made it through this past year, and even more excited to finally move out of the challenges that we've experienced and really start realizing the potential that we've been building on for more than a decade. So Mark, thank you very much. And it's a pleasure to work with you and Holly, and just importantly, a pleasure to work with my colleague and compatriot on the highway, Supervisor Rodney Lusk. So with that, thank you, sir.
Thank you, Supervisor Stork. Supervisor Rodney Lusk is a native Virginian, a graduate of the University of Virginia. And before his election to the Board of Supervisors, Rodney was the National Marketing Director at the Fairfax County Development Authority. Over the years, he has served on the Fairfax County Planning Commission, been active with the Chamber, and served on the board of SFDC. Welcome, Supervisor Lusk.
Thank you very much for that kind introduction, and thank you also to the Mount Vernon-lee Chamber. Thank you to all the attendees and participants in this program here today, and also to recognize Supervisor Stork. He and I have some significant work to do on the quarter. I'll be clear in saying the pandemic has identified where there are fissures and cracks in our community, and I'll be clear in saying it's been a disproportionate impact on certain communities, particularly in the Gum Springs, Hypa Valley. You can see the loss of jobs. You can see the sectors that Supervisor Stork indicated. Hospitality, restaurant, retail has taken a big hit as a result of this pandemic. So the board's going to have to get engaged in a way that we haven't before. And the RISE program set the marker for what we could do. And I'm really, really pleased that we were able to support, almost 5,000 companies through that program. But I'm going to be very clear in saying we're going to have to do a lot more. The recovery framework, which is going to be vital to helping us support the businesses and the sectors that have been the most impacted. The board's initiating a conversation around this as recent as our last committee meeting on this past Tuesday, looking at some new programs that we can institute. So you'll see coming forward some recommendations on that in the coming months. But I want to be very thoughtful and deliberate in saying that I recognize the pain that this pandemic has caused to individuals, and that we as a board, we talk about One Fairfax, we talk about making changes that are deliberate and intentional, and recognize that we've got to do things differently. We can see what that pain and suffering is for these communities, and we've got to figure out what we're going to do. And I'm going to continue to push. As many of you are aware, we're looking at a facility in Lee District, which will be our community center, having a component for it to include a training and workforce development center, which will be really focused on helping individuals who have really lost their jobs and are in sectors that are not going to grow and not going to give them a pathway to the middle class, to identifying others that they can get training in and get opportunities to support their families and be self-sufficient. So stay tuned for that. But I'll say I'm really pleased with the progress that we're making. Supervisor Stork indicated with the vaccination program, we're starting to see more people getting the vaccinations. We're going to be moving to this period of normalcy, hopefully soon, where we can see businesses reopening, where we can see people kind of getting out and maybe going to the movies, going to dinner, and some of the arts and cultural things that they've not been able, and entertainment things that they've not been able to do as of late. And this is going to help our overall revenue projections as well. Because if you look at the county today, we do have some significant issues with the loss in commercial real estate values. And this is really indicative of what's happened with hospitality and what's happened with office values. And what that means is we get less revenues into the county from those specific areas. But I think as we move through the vaccination program, get to herd immunity, we'll start to see a reopening, and we will hopefully get back to a place where we'll see, an uptick in each of these areas. So again, thank you for the opportunity to be a part of the program today. I'm interested in hearing from the speakers here, and I know it's going to be very informative. And I just extend the invitation, if there's anything I can ever do in my office to help with issues that you're experiencing, please feel free to reach out. Thank you again.
All right, thank you, Rodney. Appreciate Supervisor Lusk and Supervisor Stork's comments this morning. We appreciate the partnership with the Chamber as you both promote development on the highway. We know how important that is. And we know how important the undergrounding utility is for us. Right, guys? We have a great program today. There'll be an opportunity for questions and panel discussion at the end of all 4 presentations. If you have a question during the presentation, please type it in the chat area, and we'll ask as many questions as possible during the Q&A. There will also be breakout rooms at the conclusion of the program for those who would like to stay for networking, and I encourage you to do so we can try to encourage more business amongst each other locally and help out the county as much as we can. Mark?
Thank you, Mark. I wanted to also just take a quick break from the schedule to recognize SFDC's new executive director who just walked off screen, Evan Kaufman, who's sitting back down screen. Evan has been doing a great year, doing a great job at his very first year. 3 days into his new position as executive director, we had the fire down at the combined development. And then we've had the pandemic, and throughout that, he's kept SFDC going strong and our outreach going strong, and continues to work well with Holly and the chamber as well. Back to the program, though. Today's program features a distinguished group of professionals who are sharing their expertise with us. We appreciate their time and effort. As I mentioned earlier, our presenting sponsor for today's event is my friend Lynn Strobel, a well-known land use attorney with the law firm of Walsh, Colucci, Lubelai, and Walsh. A native of Fairfax County, Lynn has experienced in all phases of land use and development and specializes in land use and zoning cases for commercial, residential, and mixed-use development. Lynn will introduce our first speaker. Lynn?
Thank you, Mark. And I'm just delighted that everyone has joined us this morning. So I am here to introduce Dr. Terry Clower. Dr. Terry Clower is a professor of public policy at George Mason University, where he has served as director of the Center for Regional Analysis. Prior to joining George Mason, Dr. Clower was director for the Center for Economic Development and Research at the University of North Texas. Before beginning his career in academia, Dr. Clower spent 10 years employed in private industry in logistics and transportation management positions. He has authored or co-authored more than 120, that's a lot, 120 articles, book chapters, and research reports on economic and community development, fiscal impact analysis, transportation, land use planning, housing, and economic forecasting. He has also been a regular speaker at this event. So thank you for joining us this morning, Dr. Clower. We look forward to your remarks. Thank you.
Well, thank you very much for that kind introduction. And I'll get the screen pulled up here. As this is popping up, I guess you guys know how fortunate you are in having supervisors represent you that are as engaged as Supervisor Stork and Lusk. And for those guys, I'm going to do in the next 15 minutes is provide just a little bit of detail to what they've told you, to give you a few numbers to back up the story they've told. And I think it's real important. And I'm looking forward to our discussion component where we can talk through this with them about some of the key opportunities and challenges that, of course, that we're facing. So let's move into this. And I am going to be moving pretty quickly. Of course, these slides, as always, will be available, and as well as a much bigger slide deck that's available on the CRA website, which I'll show later. We know the story about that the pandemic just has wreaked havoc on our nation, and we had probably the worst drop in a short-term period that we've ever seen. As you can see in these numbers, the blue bars give you the kind of the year-over-year percentage change, and it was just devastating. Now, on the other hand, what you see is that, of course, by the third quarter, we were growing tremendous. We had a bounce back, all right? And that was, reflecting some of the reopening, people getting adjusted. But of course, we still remain, as you can see by that green line, substantially below where we were trending before the pandemic hit. One of the things that this has shown up is the degree to which American ingenuity and our drive for business helps us adapt, in some cases adapt rapidly. I'll just give you two quick examples as we're looking at this. Think about the degree to which the residential real estate sector adapted to doing virtual showings, closings where you didn't have to be in person. And we saw that that industry helped support a lot of other activities in the region, or just look at the pivot that we've done on shopping from home. You know, what we've done in terms of pivoting our businesses. And of course, one of our key challenges, and we think about this, is how much of that continues once we are able to engage normally. The unemployment rate is still markedly high, and I have to agree with the Fed chairman and others that while we celebrate the notion that a 6.2% unemployment rate headline number across the nation in February is certainly much better than the close to 15% that we peaked out at the height of the economic turmoil, it substantially understates the real pain that's still out there. Remember that unemployment rates don't count people who have given up looking for work. The chart on the bottom is the labor force participation rate. So we're running a good 1.6, 1.7% of the population who have given up looking for work. And if you add, you know, and of course, if you kind of add that back into the unemployment rate, of course, it's not horrible, but, you know, in terms of it's not 10% or something, but it's fairly bad. But the other piece that I want to call your attention to is that lighter green that you see up there, that is the difference. It's the unemployment rate, the U6 rate, that counts people who are working part-time that would rather be working full-time. So as we've seen in our bars and restaurants, folks that used to be, you know, working on a full-time basis are now very limited hours, you know, or, you know, they're only the person who owns it has split the shifts, if you will, to keep more people earning a little bit of money, right? As overall volumes have been down. What we were seeing prior to the recession is, you can notice that gap between the headline unemployment rate and the U6 rate had narrowed substantially over several years, but of course it has ballooned back up, and you can see that gap in there of about 5 percentage points. So this speaks to the underlying challenges that Supervisor Lusk was speaking to going forward, in that even though we have people who are working, are they getting the hours they need? And that's a key question for us. This I put up, and, you know, and when you have 100 slides to choose from, it gets a little challenging about how you do this and stay within a 15-minute presentation, but it's a real interesting one, that obviously the bottom fell out of the present situation index, as you might expect. But notice the expectations, how we as households generally feel about how conditions are going to be 6 months from now. Look at the degree to which there was remaining optimism, if you will, in the economy. And there's some artifacts of this. There's some reasons that the data show up this way that we're going to talk about in just a moment. But this points to our resiliency. And in fact, it's very important for the economy. You remember the whole thing that, you know, close to 70% of our economy is made up of consumption spending. And actually during the pandemic, it's been higher than that in percentage terms. But that expectations index is what drives our willingness to go out and buy big ticket items, cars, boats, refrigerators, whatever it might be. And so that's been an important characteristic, that we believe that we're going to get over this. Now, I'm going to not get into the psychologies of it, but maybe some of that is also a little bit of the folks that were giving us oh, well, it's not a problem anyhow. Well, okay, we can't fix that, right? There's only so much you can fix in the world. But the point is that we remained relatively optimistic about how things were going to be into the future. One of the things that just is amazing, and as I mentioned earlier, the real estate industry, particularly the residential real estate industry, figured out how to do things in a socially distanced, virtual tours, whatever it might be, kind of conditions. And we see that home sales just exploded. And this was not something that was just our region. This was across the country. We saw this phenomenon happening. And of course, that drives a lot of activity. Why are home sales so important? Think of the spending that you do when you move homes. I actually moved over the Christmas break, and I can tell you that we are still spending money left and right. Naturally, we got into the new house and my wife informed me that the old furniture was not going to work. And the remodeling and things. Have any of you tried to find a remodeler to come in and give you a quote recently? So, we've turned our spending into different forms, and one of those has been through the new home sales. And indeed, from the state's perspective, one of the things that has kept the fiscal condition of the Commonwealth of Virginia much better than what we had forecasted it to be through this period was the level of recordation fees. So what have we been seeing in this region? I'm going to talk about the region. I'm going to talk about more local stuff as we proceed through. We've lost a lot of jobs. On a year-over-year basis, almost 180,000 jobs gone away. If you think about it, that is roughly about 3.5 years worth of job growth. Good when we're having good job growth in this market. You can kind of see the past trends. Now, obviously, we've recovered from the bottom, but the downside of what we saw in the latter part of fall was that we kind of leveled out. We quit recovering in terms of job growth. Now, our early indications, and of course, we always have a lag in the data once we start getting into the regional data. So, and unfortunately, just the timing here is that this is the most recent that I have where I can disaggregate it even further. But we certainly are seeing some indications that February is going to look a lot, is going to look substantially better, but we have a ways to go. And if we get into this and talking about, what's happening more regionally, and I'm bringing it now down to the Northern Virginia, so we'll set aside the other side of the river. The phenomenon is about the same, but proportionately, we've done a little better than our other sub-regions in the market, but still down about 68,000 jobs as of the end of December. But you can see where we're starting to look a little bit better now. Now, of course, the interesting piece gets into where have the job losses occurred. You have heard in the national press and others talk about a K-shaped recession. This has been a very K-shaped recession that have hit different parts of our society much differently based on the industries that likely represent their employment. Leisure and hospitality has taken the hardest hit. We kind of figure that. I mean, in this region alone on this, that's in just the Northern Virginia side, that's 33,000 job losses by the end. And this is, mind you, with the recovery that we saw through summer and into the fall. That includes that. Professional business services looks a little bit up. I'm going to talk about that more in a minute. Folks find it very interesting about the education and health services, but of course, there's two factors that go in that. By not being in physical schools, there are a whole lot of support staff have lost their jobs. People who do critical, vital things. And of course, some of the things that have been so interesting that really, I think, calls for broader conversations. Our biggest challenge when this virus hit and we had to start shutting down the schools, us having to figure out how to get meals into low-income children's bellies. Because we've made it to where the school is the food provider of last resort for many of these families. I'm not sure if that's the best way to use schools, but it's the way we have it set up. But nonetheless, the other sector of health services that really has taken a hit, of course, has been the more profitable elective procedures kind of thing. So while the hospitals themselves may have seen an influx of activity, full beds and all of this, we had substantial periods of time in the last year where you didn't get arthroscopic surgery. You didn't have, the plastic surgeries or whatever, all of these more elective type of procedures. And those are largely what drive profitability across the healthcare sector in the private part of that. Retail trade is still down some. Federal government showed a bit of an increase, but notice the strong increase in construction. That has a lot to do with us spending money. Instead of going on trips, we spent money on remodeling and other things like that, as well as still seeing construction projects because we declared construction workers to be essential workers. So they kept on doing their activities throughout in many cases. You see these other sectors as we go through. Here's one I want to point out to you that talks a lot about the income levels on this, though. This is breaking down professional and business services between the professional technicals, think about lawyers, computer programmers, architects, engineers, those kind, versus the business services side, which are things like personnel services, security guards, waste management, which is typically the lower wage side of professional business services. Look at the job differential. In reality, in Northern Virginia, we didn't lose jobs in the professional and technical services. Our high-tech industries continued to grow throughout the pandemic. But that also meant that emphasis of paying for our folks of moderate incomes was even worse. So let's talk just a little bit quickly about what's going on in the corridor. Your major components of your economy come from, as you guys will know, federal government, the healthcare social assistance, and healthcare predominantly, retail trade, some professional services, and then accommodation and food services. So that hospitality sector. It gets, quite honestly, a little squirrely when we get below county levels when we're trying to look at the data. But our best estimate that I can come up with is about 1,500 job loss in 2020, year over year. That's on a base of about 39,000 in that. Mind you, that does not include contract workers. It does not include Uber drivers and things, people that are not under regular employment conditions, covered employment, we call it. You've actually saw gains in federal government. You saw some gains in professional services, particularly on the north end. And you saw, as you might expect, gains in food stores, because if we're not going to restaurants, we're spending more at grocery stores. Our losses, as suggested by both of your supervisors, retail, hospitality. Unfortunately, though, these are also the people that don't have big bank accounts to survive months without this. And even though we've extended the unemployment benefits, it's just made it really challenging, I think, for these households to think about it. And mind you, we still have the moratoriums on evictions and all of that going on. We have a real tsunami of housing issues going to hit us at some time during 2021. We don't know exactly when, but it's going to hit us. So what's our outlook? We are certainly in economic recovery. But here is something, and I know that Supervisor Lusk has heard me say this when he's had to endure my presentations before. Economic development in the 21st century is about talent attraction and retention. Well, retention has now taken on a whole new idea. My best estimate is that probably about 30% of the occupations in our region could potentially work from home and not return to an office. Supervisor Lusk mentioned the idea of what that might do to office market values and how that affects our tax base, right? But how we adapt to that. I'm going to challenge you, and of course, it might even affect things that we're doing in plan, like the Embark plan, right? What's the total volume? How do we roll that out if not as many people are commuting? Now, I think in reality, there's going to be a relative small portion of the workforce who will truly work remotely and may potentially leave the area. But what we want to do is have them stay at least in the region if they're not going to go every day. In any case, federal government, your spending priorities are going to be driving this. We're especially looking forward to actually maybe after 5-6 years of talking about it, that we're going to actually have an infrastructure development and repair plan. that's coming out of the federal government, that's going to boost. I'm not a big fan of running up the debt levels, but infrastructure is always an investment, whether it's done by local, state, or federal government. How does it all balance out? I think what we're going to wind up seeing throughout this year is recovery. I expect a huge surge as we get kind of that herd immunity status laying on. I'm not, assuming no weird variants come up that knock us back on the virus front. Having said that, there's going to be elements of our businesses that, our stuff that relies on business travel. That's the segment of the economy that I think is going to be years and years and years in reconsideration. Having said that, one of your greatest opportunities is how can you help your workers, particularly the ones that do that god awful slog into the district from the Richmond corridor, maybe figure out ways of letting them do their business locally. And so when they go out to lunch, they're going out to lunch at a restaurant in the corridor instead of in the district. Now, not anything against the district businesses in that sense, but how much can you capture and what's the structure of the economy? And there is nothing more important than looking at ways to do that training and the adaptation that's going to be needed by both businesses and individuals. So get that training center opened at the old high school. Get it going. Having said that, Senator, I promoted you, by the way, right there. For both of you guys, there is some research that we're doing for Go Virginia now that I think you'd find very helpful in that. And with that, I'm going to stop and move on and let the other presenters get their story told.
Good morning. I'm Don Camerata. I'm business manager with Covanta. Covanta is a leader in providing sustainable waste and energy solutions for communities such as the communities here in Fairfax. It's my honor to introduce our next speaker. Molly Bozell is a principal economist in the Office of the Chief Economist at CoreLogic, where she is responsible for analyzing and forecasting housing and mortgage market trends, including the single-family retail market. Molly is based in the CoreLogic Vienna, Virginia office. Welcome, Molly.
All right, thanks for that welcome. And that last presentation was great. So what I'm gonna do today is figure out how to advance my screen. There we go. I'm going to give you some updates on the housing and mortgage market and where CoreLogic thinks we're headed this year. So, this is probably only my texty slide. So I've got a lot of pictures here. We heard from the last presentation about the improving economy. And we also, on top of that, have very low but rising mortgage rates. We have the single family home sales and rentals are remaining very strong. But, with the work from home, the 30% of, possible work from home in the future, that does affect the multifamily sector quite a bit. And then we do have to watch the mortgage delinquencies. We had those large job losses you saw that did trigger delinquencies. I'll go a bit into that, what risk we have on that. I'm going to skip over the next slide because we heard that in pretty good detail, and move on to mortgage rates. Really the biggest driving factor in the housing and mortgage market recently has been mortgage interest rates. This chart shows the annual average of the 30-year mortgage rate. This is from Freddie Mac. And that in 2020, the average rate was 3.1%. That's a full percentage point below the long-term average from 2010 to 2019. Really, the reason mortgage rates were important was it not only drove refinancing, which I'll cover in a bit why that's important, but also created a real purchase incentive for those who were really looking to lock in those low mortgage rates. And that helped drive a lot of that home purchase demand you saw last year. well, mortgage rates are expected to stay historically low. See, they're not going to pop up above that 4.1%. They are expected to rise this year and next year. And well, they'll rise kind of near the end of the year. And that will cut into affordability, making those monthly payments a little higher, and also cut into refinancing, at least the rate and term refinancing. So, speaking of refinancing, we like to show this chart to really show the potential for what could be left in refinancing. We call this our S curve because it kind of looks like an S. But this chart shows the cumulative share of home mortgage loans by their current mortgage rate. So what borrowers are currently paying for their mortgage rate. And looking at this, like I said, can help us size that refinanceability. So about 30% of mortgages outstanding have mortgage rates above 4%. Given where mortgage rates are right now, they still have a refinance incentive. Coming near the end of the year and into next year, that will start to dry up. That's about $3 trillion nationally, 20 million loans. So really big refinance possibilities, or at least the first part of this year. Now, not all of these will refinance. Some have pretty low balances. Some people have been in their homes a long time. We call that burnout. It's not worth it to refinance. But some will refinance, and a lot, that once the rate and term refinancing dries up a little bit, we usually see that cash out refinancing starts to kick in, and that will really help with this spending on consumer goods and home improvements. Let's see, why not only have mortgage rates been low, but another driving factor of the home purchase market is demographics. We've been talking about this group for years and years, and then finally they're buying homes, and that's the millennials. And there are 14 million of them there. I've highlighted in red. That's the largest age cohort, and they are approaching that typical first-time home buyer age. And that strong demographic will help drive purchase activity over the next few years. And I'm showing that here in this chart, really just showing what share of households, this is from 2018, how these generations make up the share of households. While millennials and Gen Z, we don't talk about them too much. We're starting to talk about them a little more, especially for those of you in the retail sector. You've probably been looking at Gen Z for a while. This growth in the millennial and Gen Z households will counterbalance the losses we're going to see in the older generations. From 2018 to 2023, there'll be 6.4 million more millennial households, 5.7 more Gen Z households. And they will drive demand in rentals, the Gen Z especially, but also in entry-level home buying. And as you heard in the last presentation, when you have households form and home buying, they have a lot of purchases that go along with forming those households and buying homes. So that will really drive things for the next few years here. So we heard about this in the last slide or in the last presentation. Work from home might become a long-term solution for a lot of companies. I know just where my spouse works in Fairfax County, they're gonna make it a long-term thing. So that will drive this need for space, and we have seen this shift in the need for space. So less need for commercial space. And we've also seen this shift to people wanting to opt for lower density housing. So wanting to move out of, city, wanting to move into a single family or maybe even a smaller building. And we see this shift in rents for single family and multifamily. Single family rents have softened a bit in 2020, but by the end of the year, they came back and were increasing faster than they were before the pandemic. And that is at the single family vacancy rate decrease. Multifamily rents really went the other direction. So if you're in that business, you saw quite a different story. Multifamily rents decreasing through the end of last year. And again, that's as vacancy rates for those properties increased. This just shows a little detail. We have some information on different areas, single family rent increases in different areas. And here you could see that while the nationally, the national average in single family rents was increasing, there was a really wide variation by location. In the Southwest, things are really booming out there. A lot of people moving to the Southwest. Phoenix, Tucson, seeing double-digit rent increases for single family rents. They're even building single family rental housing in that area. So, it's a big business when they're investing like that. But then other parts of the country, look at Chicago, Boston, Honolulu, decreases in Chicago and Boston, Honolulu flat. And that really goes back to the speed at which places are recovering. And as you heard in the last presentation, the types of jobs in those areas. And in the case of Boston, really students not wanting to go back and rent in their expensive housing market and while they're doing school virtually. So that Boston's seen quite a big drop. This area kind of average. And, if you looked at the job gains you've seen back from the pandemic, sort of, about like the national average of increases in rents here. Virginia Beach, on the other hand, kind of near the higher end of increases in rent. So we do see a big difference depending on where you are. We heard a little bit about mortgage delinquencies, what's going on with that. So let me just cover real quick with this idea of the foreclosure and the double trigger. You might see this thing, what I've mentioned here, the double trigger, it was a really big factor in the last recession. And that double trigger I'm talking about is a job loss plus a loss in home equity. So a loan, as I see here, sort of the timeline here, a loan could be current, you have a job loss, you go delinquent. If your home prices decline and someone owes more on their mortgage than the home is worth, they will probably head to foreclosure and bank sale. But this time around, we really have a different situation with home prices. Home prices have been going up for the last 9 years, really, and really intensified in 2020 as space or the inventory of homes for sale really shrank as people were searching for those homes, trying to get in on those low mortgage rates. So we've seen a really large increase in home equity. So we're not really seeing that as much of a problem, at least in most places in the country. CoreLogic, we track negative equity and also equity in, the dollar amount of equity in homes. And home prices, like I said, have been rising for the past 9 years, and that has led to record amounts of home equity. But it's not high in all parts of the country. Here, I'm just showing this by state. You'll see the areas in red. Those are really some places to watch. Of course, on below the state level, and even much lower, you probably have some ideas of areas to watch. But in highlighting here, we have Louisiana. 8% of mortgages there are in negative equity. And New Orleans in particular has a pretty high unemployment rate. And we do expect home prices to fall this year in New Orleans. So that would definitely be a place to watch, could lead to some foreclosure problems for that area. And on the other hand, while Las Vegas has a really high unemployment rate, home prices there have been booming. I think as more new people moving to the area, really looking for a cheaper place to live. We heard about people relocating while they're working remotely. That a lot of that is happening in Las Vegas, and only expect to see small decrease in home prices. And the negative equity is pretty low there, actually below the national average. So you could see how things would be different depending where you are. And in Virginia, negative equity really low. So, things, the home equity buildup has been a really good, has been helpful for the home equity. Coming down to home prices, between 2010 and 2020, you could see kind of long run average of home prices. You could see that in 2021, we do expect home prices to continue to grow, about double the long-term average from 2010 to 2020. So pretty robust home price growth on average you'll see in Virginia and in particular Fairfax County. But then coming into next year, prices still expected to increase, but really back down more to that long-term average rate. Thinking more about home equity, what's that mean for each home buyer or borrower? We have here I'm showing the equity gains by state here, and this is a 1-year equity gain. So just in 2020 alone, the average home equity gain was $26,300 per home in 2020. So that's a really large gain. In Fairfax County alone, $52,000. So again, these large equity gains, they're going to help prevent that large scale foreclosure and distressed sales we saw in the last recession. Now, as you heard in the last presentation, this all depends on, where the job market's going. It also depends on what happens with this forbearance situation we have right now. Right now, if someone is delinquent, or if a borrower is delinquent, as I'll cover in this chart where delinquencies have gone, if a borrower is delinquent, it's not, they can't move into foreclosure. Okay, so there's a foreclosure moratorium. The delinquencies aren't hitting their credit reports. The only, when they come out of this forbearance period, most of these borrowers are going to see their payments added on to the end of their mortgage. So, it's not right now. We're not seeing credit hit or any of that from the delinquencies we're seeing. But in this chart, you'll see this does not include the forbearance. So this is just purely the borrowers who have missed their payments. And I'm showing what we call serious delinquencies, or these are 90 days past due or more. In 2020, after the pandemic, that spiked to 3.9% of all mortgages in the US in December, 3 times the rate before the pandemic. And but it was below what we saw in 2010 at that peak back there. Now, the red line, I'm showing what's happening in Fairfax County. Sort of similar situation. Now, the trend increasing, but those delinquencies are kind of back to where they were in 2010, that severe stress period. So now again, keep in mind that these delinquent loans are in forbearance, but when that forbearance is lifted, it really will remain we don't really know what's going to happen with those borrowers. Will they stay in their home? Will they have to sell? So, even though borrower has equity, if they do remain delinquent and they come off forbearance, they'll most likely need to sell the home. So again, depending on the situation, we could see some distressed sales, but probably not like we did back in the last recession. This just kind of covered this summary of what I covered there. And I'll let you know that if you want to check for more updates, we have a lot of information like this on our blogs. We have some press releases out there. You can check at corelife.com, and we also have a Twitter.
Well, Molly, thank you for that great presentation. Really appreciate all that information. Good morning, everyone. My name is Mike Kitchen. I'm a vice president with Christopher Consultants. a civil engineering, land planning, surveying, and landscape architecture firm serving the Washington, D.C. region. And it's my pleasure to introduce Barbara Byron, Director of the Fairfax County Office of Planning and Zoning. Before taking on this new department, she was the Director of the county's Office of Community Revitalization, and was previously Director of the Zoning Evaluation Division. Barbara is a great leader and has played a primary role in the county's public-private partnerships, including the formulation of community development authorities and tax increment financing initiatives to encourage new development. Barbara, welcome, and thank you for participating in our event.
Good morning. Thank you, Mike, and thanks everyone for inviting me. This event is something I look forward to every year, but next year, hopefully back at the country club. So I wanted to take a minute and talk about the good things that are happening on the corridor. So the corridor is such a long place that we kind of lose sight of how much is happening because it's dispersed along the almost 8 miles. So I wanted to give a very quick tour starting at the north of some of the important things related to development that have been occurring and are occurring right now. So starting at the very north, finally, after many years, we have the North Gateway Plan Amendment approved. I know many of us have looked forward to that, and that's very exciting, particularly since it got the interchange off the plan map. In the Huntington area, we have almost 600 new residential developments that are either under construction or about to be constructed. They include Wesley Housing, Huntington Crossing, and the Avonton at Metro. We also have a comprehensive plan amendment underway for the WMATA site itself. Moving a little further south, we know that in the PennDOT area, South Alex is under reconstruction, and it's coming along great as I pass by, and Novus across the street from that, also moving along with its residential development. The Fenton property has filed its zoning case. We've spent a lot of time over the years trying to find the right development to work on that site, and we're very excited that that's finally in. North Hill, of course, is under construction, the county's project there. Moving a little further south than the Costco, on the Lee District's side, the Mount Vernon Gateway application, the zoning application, is being filed by a well-known local developer. Across the street from that in the Triangle, we're looking at a plan amendment to replan the area that used to have the Thieves Market. I skipped over an important location on the way down south. Gum Springs, we're spending a lot of time and effort looking at putting Gum Springs on our historic inventory and evaluating its historic significance, which I think is undeniable but needs to be documented. Obviously, as the supervisors talked about, the BRT and VDOT widening projects are well underway, which of course is huge. And in terms of multimodal transportation, major sections of the Cameron Run Trail will be completed with the developments that are happening at Huntington Crossing and Riverside. So that's a lot of development happening along the corridor. So it's keeping our office very busy, and we're very excited about that, and for all the participation that others have given along the way to make these things happen. So thank you.
There's a lot going on. It's very exciting. Thank you for that. Good morning. My name is Dave Stigler. I'm a land planner, site designer with Pannoni, a design engineering firm with a long-standing presence in Northern Virginia, including this Route 1 corridor. Fairfax County has recently adopted a new economic incentive program, which will have a significant impact on the areas in need of new investment. Elizabeth Haig, Section Director of the Community Revitalization Section in the Department of Zoning and Development, will brief us on this new program. Elizabeth?
Thank you very much. It looks like revitalization is a tough word to get out, and it's a tough thing to make happen. But I'm here to share with you all a very new, exciting tool that we have to spur economic development in our commercial revitalization districts and areas. So it's a very exciting time. Let me bring up my slideshow. So I'm going to go into today about a little bit about the program, what its parameters are, and tell you a little bit about our very first project, which is very, very exciting. Just get this down. So in 2017, the Virginia General Assembly adopted House Bill 1970, and that allows counties to offer financial and regulatory incentives to the private sector to assemble, revitalize, and redevelop property for economic development. And the county immediately recognized this would be an important tool to add to our revitalization toolbox. And in part, that's because we've been trying for a long time to revitalize our areas. We've done replanning to encourage redevelopment and reinvestment. We've got the overlay districts with regulatory incentives. We've made streetscape investments in these areas and a number of other strategies. And some of that has worked and some has yielded mixed or as yet unproven results. And I think we know there's a lot of potential, particularly on the Richmond Highway Corridor. We're investing close to $1 billion in public transportation infrastructure. The recent market study for Richmond Highway indicated very strong residential demand in the next 10 years, but modest, I would say, commercial demand. And so I think there's a clear recognition, and there has been for some time, that we need a financial incentive to overcome many of the market challenges that we face and expedite the desired change. And I'm happy to say that as of last year, September 15th, the board did adopt the Economic Incentive Program Ordinance. And that's really important because what we really hope to do is move away from a lot of this that we see in our areas, this suburban pattern of development, large expanses of surface parking, auto-oriented uses, and move towards a more urban style, mixed use, transit-oriented development. And I have to say, property consolidation has been one of our major challenges. And as you'll learn as I go through this presentation, this program specifically is designed to target that consolidation issue. So we've got something at last. So let me go over the financial incentives of the program. First up, as you come in with your project, there's a off the top reduction of site plan fees by 10%. Then later on, after the project is completed, there is a real estate tax abatement. And that is going to be based on the difference between your pre-development value and your post-development value. And so that can be quite substantial, but it is post-development. So just to show you what that could look like, let's just say your project had a pre-development value of $5 million. This is just hypothetical. And after completion, it was worth $120 million. So that increment of $115 million is what would get the tax abatement. And under the law, you get up to 10 years for that tax abatement. And so based on, well, now that the tax rate may change from this example, it's $1.15, it may be $1.14, but as it's currently on the books, $1.15, that would yield a little over 13 million over a 10-year period. So it's not nothing. It's quite an inducement. Now, we do require certain, you have to jump through certain hoops to be eligible for the program. One of that is what you're developing. So to be eligible, you must be developing either multifamily residential, commercial, office, retail, hotel, or industrial, or you could do a combination of those. So all of that is good. You must be, now here's where the consolidation comes in. You must be a minimum of 2 acres, and that is got to be a newly proposed assemblage. So it's not that you've previously assembled something, but as you're coming forward with a development, that you have at least 2 acres. Now there is, if you're close to that, the board has some discretion as to, whether it would be seen to be close enough. And let me just say, an assemblage means the combination of adjoining parcels with different owners into a single development. Another requirement is that it be a new proposal, not previously submitted for rezoning or site plan approval. And it can be a total new project, a complete redevelopment, although you may retain a portion of an existing building or all of an existing building into the redevelopment, but you're still adding new development. Or it could be a repurposed building. And I'll have an example later on where our first project in is actually that type of property. And then you must be in one of our what we call EAP areas. And there are 6 of them, and they align closely with our revitalization districts and areas. So we've got Annandale, Bailey's Crossroads, 7 Corners, Lincolnia, McLean, and Richmond Highway. We've strung together the entire corridor. It's not just the CRDs. And then in Springfield, we've added a portion of the transit station area. So, and the board could add additional areas in the future, but this is what we started off with the program. And this just shows you for the Richmond Highway area, and going left to right, we're starting here at the North Gateway at the I-495 intersection, traveling south. This is the center section, and then all the way to the south to Jeff Todd Way there. So the total 7.5 to 8 mile corridor is included, and it basically includes every parcel that touches on the corridor. And all right, so then I want to get into timing. This is a little tricky. So while the program was approved on September 15th, 2020, so it's now in effect, certain areas have different start dates for when the financial benefits could kick in. And you may ask, why was it set up this way? Well, it's in part because it takes a long time to go through the entitlement process and the construction process. And so we wanted to help our areas avail themselves as much as possible of the full 10 years. And we knew that we had some projects that people were interested in pursuing. And so there are different dates for some of the areas. Our first area where the financial incentives would kick in would be the Bailey's Crossroads 7 Corners Economic Incentive Area. And that will start July 1, 2022. Again, these are 10-year periods, so it runs to 2032. And then Richmond Highway is July 1, 2024. So we have some projects that we think are coming in. In fact, Barbara mentioned that the Fenton property just submitted, and they will be, to our knowledge, be pursuing this program and have worked diligently with neighboring property owners to line up a consolidation in keeping with this program. So we really believe that, again, that site has been struggling for over a decade to redevelop, that this economic incentive program probably made that possible. And then Annandale, Lincolnia, and McLean, we think those areas will be a little bit later. McLean, we're just finishing up a big comprehensive plan amendment. So now I want to just briefly take you through the steps, 3 easy steps. Let me take you through each one on how you get through the process. So first step, we have an application form. You fill that out, and we do kind of a preliminary take on whether it appears that you would meet the eligibility criteria. And We work with our Department of Tax Administration. They do all the assessment and valuations. And so they would do an estimated base value of your property that you're proposing to use the program on. Then it's fairly normal. You would go through the normal rezoning process, or if it's a by right, a site plan. That then ultimately, though, the final approval of the eligibility rests with the Board of Supervisors, and that action should go forward with. If it's a rezoning, you have to go before the board anyway, so that should go before the Board of Supervisors, or be a separate application for a site plan. Once the board approves the eligibility, your project becomes deemed, quote, a qualifying property. And you would then ask DTA for your final base value. So this sort of starts, what are we going to be comparing the base value with the final ultimate build out value? So that gets done at that point. Then you go forth and get all your permits, build your project, and then work with DTA yet again to get your final market valuation. And then when we have the beginning and after values, then DTA can calculate what your tax exemption amount would be and how many years or whatever are left in the program. Again, with those dates that I showed you on the previous slide for the various areas. And I just wanted to highlight, this is our first application in. It's going to the board next week for approval. I don't know how many are familiar with, this is in the Bailey's Crossroads area, the huge skyline development. Well, if we've been talking this morning about declining, or I should say, increasing office vacancies, this skyline has suffered even before the pandemic from significant office vacancies. And one of our developers was able to acquire all three of these office buildings, sort of here you see in the middle, or an image of them here. They are completely vacant except for a handful of some retail tenants on the ground floor. And so that is going to be repurposed into up to 720 live work units. And what's so exciting, this is looking at the ground plane, is that they are able to, through this program, really enhance this area around here. There were previously two park areas, but now they've literally expanded out into the surface parking areas to create a total of 1.1 acres of open space. And this is open to the public. It's going to have exciting things like fire tables, and there's shade structures with swings and all kinds of seating areas, climbable art. So this will become a huge amenity. And but for the economic incentive program, this probably would not have happened. So all of the information about the program is on the Planning and Development Community Revitalization website. We've got the forms, we've got the ordinance, maps of all of our areas, so you can look to see if an area you're interested in developing in would be eligible. So please spread the word. We want everybody to take advantage of this great program. We're happy to come and speak to any of your groups or anything like that. So please help get the word out. And again, here is our website, or you can email me for additional information. And I thank you for your time and attention.
All right. Thank you, Elizabeth. That was awesome. Great presentation.
Thank you very much. I guess we're getting some questions here. I'm going to respond to a couple of things here. Elizabeth, real quickly, with regard to the interest you've got so far from this, how much interest have you seen? We had a couple of years this much vaunted the opportunity zones were going to be a big game changer, and I think mostly because of the slow rollout of the implementing regulations, they never really kind of realized their potential. I think I know I've seen already just a lot more. I think this is almost like the old enterprise now. This is a lot more targeted, a lot more just common sense application. Yeah. What have you guys seen? We talked about the Skyline project. Any additional interest you've seen from developers in the area so far?
Yes, there are several that we're working with now on the Richmond Highway corridor that are that this program specifically is driving their interest. I mentioned the Fenton project, which as we all know, that site has struggled to come together, and they're able to, at least we have a contract to pull in some property from along Quanda Road with a developer who wants to do townhomes, and the Fentons do multifamily. So it's really exciting to see. These are hard things to accomplish, the assemblage of property. It's been a major stumbling block for redevelopment in our areas, and now we can finally offer them an incentive that hopefully gets them over the hump to make these projects happen.
There was a question out there about, is there an Amazon impact? I don't know if that's something that Elizabeth, you want to take on, or Dr. Clower, I'm not sure.
Well, I can address that to a little bit. And so, and appreciate the question, Catherine. And let's just say, first of all, well, what do you mean by Amazon? And let me kind of just tick through it. So the huge thing that, we talked a lot about Amazon HQ2 being a big boost. Amazon Web Services has been a key part of our region for quite a number of years now, several thousand employees. I've seen numbers upwards of 10 or 12, though they don't advertise what it is. And that continues to grow. I think that's mostly going to be Ashburn, Herndon, out in that area, but we get some of it in Fairfax County and some tax base out of that. And keep in mind, the thing about it is, you wonder about Amazon doing all of this free shipping and everything. 85% of corporate profits come out of Amazon Web Services. Now, in the long run, that probably is not good, because it means they push other retailers out of business through cross-subsidization. And certainly, I would not be a bit surprised if there's some regulatory talk on some of that cross-subsidization in the next few years. The other piece that's more local is that new or relatively new mini fulfillment center that they've built in, I think it's Springfield, if I'm not mistaken, specifically to serve the DC market and all. That, I believe, if you have sites along the corridor that can handle the traffic volume, the small van truck volume, I think that creates some real opportunities, because we're going to, much like you talk about in telecommunications, getting fiber to the curb. The issue is, for these fulfillment centers to work effectively, you're getting to where you need to get them closer to the ultimate delivery point. What's amazing is, things that, say 5 years ago, we'd been quite happy if we got an order from Amazon in a week. And now it's like, oh no, we want it tomorrow, right? And it's free shipping. Now, of course, I'm going to assume that you were really talking about HQ2. And HQ2, of course, is going to be the huge thing. The last number I saw was from last summer, and they're at about 1,000 employees. So you put that against, us losing 66,000 jobs, over the year, that it's not a big impact yet. It's a bigger psychological impact of demonstrating that we are a real area for growth in the private sector, not federal government contractor area. We can compete effectively for businesses outside of that. The big hit, I think, and when I say big hit, and not hit in a positive, or a hit in a positive way, is I think that first major phase of their expansion is still scheduled for mid-23, I believe, and some of the other folks on the call may know that more, but that's when I think we'll start really see that ramp up, and it'll kick up. but that's going to be that's a slow burn growth. The other thing that I tell you to think about, Amazon might well be, even though it's not that far away, there's going to be some displacement effect of Amazon. Amazon is going to, they're going to outcompete a lot of small businesses for labor. There might be opportunities in the Richmond Highway corridor for businesses that are needing just to get a little bit further away from the big behemoth headquarters, and and employees that may not want to live and work in Pentagon City. I think you may actually have some business development opportunities come spilling out of that.
Wanted to ask a question for the supervisors. I think they're still on. So wanted to ask where the corridor stands with county on funding the underground utilities in relationship to the initiative that Supervisor Lusk is providing with training and development at the former Mount Vernon Athletic Club. To attract some quality businesses, we want to make sure that they have great utility services. That's why we want to get them undergrounded, to attract the businesses that are necessary to be able to provide our underserved population with great jobs. So curious as to their thoughts on that.
We are definitely aggressively working this issue. We are trying to find a pathway to secure the underground these facilities, but I will be perfectly frank here, it's about cost and how we make that happen. So I think we're going to continue to look at the options that are available for us to do that and to figure out what makes sense. But we don't have that resolved as of right now, but we are still aggressively looking at it. And to your point, I agree. I mean, it's going to look a lot better to have the utilities underground. I mean, all of us want this, but I think the reality is how do you pay for it? And that's where the rubber kind of meets the road. On the issue of the training center, you make a good point. I mean, it certainly would be better. And I think what we have to really still be focused on, Mark, is the opportunity to help reskill these individuals and really get them to a place where they can move into positions that are going to give them, higher quality pay and long-term advancement. So this is like a kind of a ladders of opportunity. This is the terminology that Carla Bruce uses when she talks about how we want to support and service folks in this county. And I think we've got some hard work to do here, but it's going to make a huge difference in the overall trajectory of these folks' lives. So I'm real excited about both exercises and trying to figure out how we get this coordinated along the historic Richmond Highway corridor. Thank you.
So we've got another one of the questions that was about generally to the board. How will the pandemic, or I guess the post-pandemic world, affect the international development of the region?
So, I mean, I worked in economic development for 21 years before I came to the board, and my job at the time I was there was on the national side. And I'll be clear in saying that we've been very fortunate because of proximity to Dulles on the international front. So we've seen pretty large employers make the decision to locate here, and then we've seen them stay. So Volkswagen was a prime example. BAE is another example. Intelsat. I mean, we've had some significant companies who have international presence who basically said they want to be in this marketplace. I think that's going to continue once we get past, the pandemic, and once we get people basically back on airplanes. I mean, the point is you want to be close to an international airport because you're flying a lot into that international airport. Today, that's not the case, obviously. I think that will come back as well. And then the point that Terry Clower made, I think, is really important too, is that the fact that Amazon made the decision to put HQ2 here in this community is an indication that we are a viable market for multinational, Fortune 500, Fortune 1000, pretty much any type of company should be considering it. And I'll be honest in saying companies are like developers. They're lemmings, meaning they go where the action is. If they see someone making money in a particular market, then they want to go to that market as well. So we're going to be aggressive, obviously, in the county and promoting Fairfax County as that ideal location. But it's not just us making that assertion. That has been made by the decision that Amazon has made, that Microsoft has made, that Salesforce.com has made, that countless other companies, and I can just keep going on and on here. The point I'll make, though, and I'm sorry not to go so long, the companies have taken the position that they want to be principally along the Dulles corridor. So Herndon, Tyson's, Reston are really the places where you see that amalgamation of those companies, and the infrastructure that's being built there now is going to make it even more substantial. Just think about this. You have the development in the Reston Town Center, and the Reston Town Center does not have a metro location. What do you think is going to happen once you put a metro at the Reston Town Center? It's like a no-brainer. The same with Herndon, and then out to Loudon. So, you know, we have to figure out what opportunities the corridor is going to have as it relates to technology and innovation. And this is a different question. We can't compete with Reston and Herndon and Tyson's on the core areas. So I don't think we're going to be big in cybersecurity. I don't see us taking the big data market. And, you know, in general, we've got to think about what are the emerging tech areas that we can try to establish here in this market. And this is the question I'm trying to kind of grapple with myself, and how we can start to position the corridor to be an area for, say, sensor technologies, for drone technologies, for building technologies. There's going to be an opportunity for us. We just have to kind of carve our little niche out and then start to support those companies strategically, and to get them to locate and expand here on the corridor. So that's a long answer to the question, but clearly we're definitely thinking about this issue. So thank you for the question.
Rodney, that's a great answer. And that's why I keep going back to undergrounding, to attract these folks to come to the corridor. Question came up, and I know this came from Catherine, but I know Travis has asked before.
Sure.
Why is there such reluctance to bonding and trying to not secure bonds to underground utilities on the highway? It seems to be a huge reluctance, and money's cheap, and the time wouldn't be right to do something like that. Why is the board not so warm to it?
Well, I mean, I can't speak for the whole board, so I'll just make the point that I worked again at the Economic Development Authority. I handled the bond issuance for the county for 20 years as it relates to the EDA bonds, not the general obligation bonds, economic development, industrial revenue bonds. So the thing about bonds is that you have to have a dedicated revenue source. And those bonds are either amortized on a roughly 15, 20, 25-year term. So you've got like a mortgage. So the thing that you have to remember is that you've got to be able to show a dedicated revenue source over the life of that bond issuance. And that's where I said the rubber meets the road with regard to being able to support the repayment of those loans, or being able to upfront the capital to secure the underground those utilities. So you can do it kind of in a couple of ways, but you've got to be able to show the availability of the funds to support the underwriting of those bonds. And right now we do not have that. That's the problem.
And Mark, if I might, and one of the things that I think is kind of a little bit of a managing expectations coming out, certainly the relief package that Congress has just authorized will have support for local governments. But we are in for, I think, 2 or 3 years of very unbalanced, even precarious finances for local governments. State government seems to be doing well, but I was on a Zoom call that included one of the senior legislative leaders, and I asked about whether or not the state, since it's in much better shape than they had anticipated, was going to provide any relief or support. And the answer was a very hard no. Not going to happen. You're not going to get anything coming out of Richmond to help. And you think about this is even if we shift 10% of office demand, the line of people that are already out the door wanting their commercial properties revalued and valued at a much lower level is going to put some real strain on finances. That combined with the concerns that I've seen rating agencies put in a couple of recent reviews of Fairfax about pension obligations and things like that, we have to protect that excellent credit rating, or things are going to get really ugly on our tax rates. And so but having said that, the innovative way of maybe the approaching of TIF type approaches like the other incentive, maybe there are ways of forming public-private partnerships with developers to help share some of that notable expense, because it's in the developer's interest as well. As you well saw. So I think there are approaches to take. I'm not trying to shut it down, but I think right now it's going to be very difficult for the county to look at major initiatives over the next 2 or 3 years as we see how all of this long-term effects of the pandemic impacts our real estate markets, particularly commercial real estate.
Yeah, and if I could jump in here too, I just want to note, and Terry, thank you for reminding me that we do have some stimulus money coming in. The beauty though with that is we haven't received that allocation yet. I think it's scheduled to come towards the end of the month, at least in the first tranche. I think the county will get close to 200 million. It's similar to what we got in the previous allocation for CARES. But again, to the point that Terry made, those are one-time expenditures. Like, you can't baseline that in your budget. So we wouldn't be able to take those stimulus dollars and use them to bond and pay for the debt service on those bonds for the underground. So we wouldn't be able to do that. I do think that we're going to have some opportunity though to think about how we can support business with this stimulus money, especially those businesses that have been impacted by COVID, and then also to think about our not-for-profits and others in the community. So I'm hopeful that we'll do some of the same things we did with the CARES Act funding to support our community. But we've got to remember that this is not money that we can obligate into future years of the county's budget. So going back to Terry's very astute point, we're kind of in a uncertain period because we don't know what's going to happen with office. As a person, again, who's worked in economic development, look at how values are determined. They're determined based on vacancy. So if the vacancy goes up, the value goes down. It's like an inverse relationship. So you've got to be very careful if businesses are saying, we're going to reduce our building's footprint. That means they're going to have less space for the same number of people in future leases, which then translates to that building being less kind of valuable, which then translates into the county getting less tax receipts on that building that we might have, assessed at, 10 million, last year, and then this year it's down to like 6. So that's the challenge, and we just don't know where this is going.
There was another question out there that was asking if there are incentives on the highway for low-income housing and for those with disabilities and for senior populations.
Well, our Department of Housing and Redevelopment Services has been the entity that's done a lot of the low-income tax credit program financing. So that's done at the state level. There's kind of 2 programs for that, and they do allow for housing that is considered, for older, 55 and up, and then for those that have disabilities. So yes, there are programs that exist, and if someone's interested, we'd be happy to get them connected to Tom Fleetwood in the Department of Housing to talk about that.
Yeah, Mark, and Virginia Housing, that used to be called the Virginia Housing Development Authority, has specific grant programs, particularly for accommodation grants. In other words, you need ramps, or you need to do other things for mobility impairments and other accommodate other disabilities. They have quite a number of programs that provide, not huge dollar, but enough to really substantially help offset the cost of doing accommodations in residential properties.
Now 10 o'clock, so we're kind of at the end of our main program. Holly and Mark, you want to take it from here? Here we go.
Sure thing. Sure thing. So we appreciate everybody being here today. We've had a great program. We're glad that people participated. It was a fantastic panel of speakers. Feel free to note that we're going to have a recording of this on the Chamber website. And this concludes our 2021 Economic Outlook. Thank you, Supervisor Lusk, and Christine. Tell Supervisor Stork we appreciate their time, and panelists, it was awesome to have you. It was really helpful today.
Thanks a lot, everybody. Have a good day.